Welcome to the Real Estate Women's Podcast. Thanks for pulling up a chair to our roundtable discussion. Here, we'll teach you how you can create a stream of passive income through multifamily investing, and we'll help you to shift your mindset so you can start living the life you really want to be living by design today.
Hello, and welcome to the Passive Investing Podcast. My name is Colleen.
I'm Tamara.
And I'm Crystal, and we are the Real Estate Women. In today's episode, we're going to be talking about lending, the basics of lending, some things on how to get ready. If you're ready to make your first investment, we're going to have some helpful tips and tricks along the road here in this chat for you. And we have the one and only Rob Serpa. He is amazing. So, hey, Rob, how are you doing?
I'm doing very well, Crystal, Tamara, and Colleen. Thank you very much for having me on.
Yeah. Thank you so much for being here. Just to fill you guys all in a little bit more about Rob, he is a seasoned loan officer. He's going into his 5th year in the industry. He's currently serving as a team leader at Milestone Mortgage Solutions. He is a President's Club winner and a very well-respected leader in the mortgage space. He's super passionate advocate about veterans, and he's a Mission 22 ambassador and a very proud board member of his local chapter. What's super awesome that I absolutely love that he does, he donates $100 from every one of his closings to support the fight against veteran suicide. Rob is well known for his personal approach and just his calm and stress-free process that just keeps everybody along the road super confident. So we are super happy to have you here, Rob. So thanks a million for joining us.
I appreciate that. That was one heck of an introduction. Thank you very much. You should introduce me to all my clients.
Hey, this episode will always be there to listen to. So,
Exactly.
Yeah. So you know what? Let's get right into it. Okay. So, a lot of our listeners here, they're kind of ready to make their first investment, right? So they have maybe they've purchased a home, but for this conversation's sake, let's say, we're sticking to kind of the real estate and lending side of things, and we're looking at deals between like 1 and 4 units. So Rob, in your experience in that space, what are kind of what are the most popular types of loans that are used for these types of purchases?
Okay. So right now, if you're looking to get an investment property and you already own your own home, the most popular loan and quite frankly, the easiest one to do, it's called a debt service coverage ratio loan. So going forward, I'm just going to use the terms DSCR. Okay. It's an investment property loan. It's not meant for owner occupied. So this is a home that you're strictly going to buy and then rent. And the best way to describe it is as such: 20% down. Okay. You can start with 20%. Usually investment property loans are 25 or 30. With this particular product, you can start with 20% down. And once the appraiser goes out, they determine a value on the property and they determine a value of the rents. And if all of the rents combined equal your mortgage payment, we're approved. So you actually don't need a job to do this. If you live in a home now and have the 20%, we could talk about how to get that 20% in a few minutes. You can get into an investment property and start building your real estate portfolio. As we know right now, the only thing not going backwards is the value of a home. It's a great time to do it, and we've definitely got some good products to get help people along.
So what does that look like compared to like someone buying their first home and like the qualifying, or what could you enlighten us about the process of that and what that looks like and how to like prepare?
Sure. Yep, absolutely. So number one, if you own a home now, you don't want to miss a mortgage payment. Okay, you don't need an 800 FICO. But if there's a mortgage late in the last 12 months, we're probably going to have to wait until we cycle through that mortgage late. Okay. So you got to be up to date with your mortgage. That's the number one ante into the game. You do need a good credit score, the interest rate and such, and fees. We could talk about that if you want, but your interest rate will be determined, or part of it, by your FICO. Okay. So have a good credit score and be very mindful of not missing any mortgage payments. You should never miss one ever. But if you're looking to invest, that's the last thing you want. Reason being, because a lot of times I get asked the question, well, everyone's human. We all make mistakes. Why do they do it that way? Well, it's pretty simple. You live in your home. You're going to do everything you possibly can to keep that home stable and a roof over your head, your kid's head, your husband, wife, whatever. An investment property loan, the lender's going to look at what you've done with your primary. If you haven't been on time with your primary, why would an investor give you $500,000, $750,000 to buy a home in which you're not going to live? So that's the easiest explanation for that. The second thing is, and there's a second and a third that I'll add on to now. I don't want to get too long-winded in the beginning, right? The second thing is you need to have that down payment. So 20% down. If you want an ideal loan with the least amount of fees, by fees, I mean points being charged on the loan, okay? And the best interest rate possible, let's try to get you to 30. But 20 gets you in the door, okay? We can worry about a refi and all that stuff later. 20 gets you in the door. Finally, you're going to need reserves. Reserves are defined as whatever the mortgage payment is, you're going to need a minimum of 6 months of that in the bank ready to go. Inflation broken down real easy. Your mortgage payment is going to be $5,000. We already know the rents are going to cover that, so no one needs to be alarmed. The rents are going to cover it. We probably wouldn't even try it if we didn't think the rents would, right? Not that I'm an appraiser, but of course, I try to keep things within reason. So we've got that part covered. You need to have $30,000 in the bank. So that's in addition to your down payment. So on a $100,000 home, we're looking at $500,000. You're looking at $100,000 down. Call it another 10 for closing costs, whatever, 110. You now need to tack on 30 to that. It never enters the equation other than the underwriter knowing that if for whatever reason these people don't rent this property and you now have to pay for it, you can go 6 months with those apartments or that home being vacant, and you're covered. So really quick recap: good credit, no mortgage lates, 20% minimum down payment. I'd like to see 25, but 20% minimum down payment, and 6 months minimum of that mortgage payment sitting in an account. And the account, by the way, cannot be crypto. If it's crypto, we have to have a different conversation. We're going to liquidate that stuff. We're going to put it in a bank. That's a very, very, very different story. So, and I'm sure a lot of younger people watch this podcast. So I would say if you've got crypto, let's have a conversation. Crypto's not bad. But if you plan on entering that into the equation, we just have to prepare properly for it, and I can certainly help with it.
Well, that's a really good, helpful tidbit, because that was something, I wasn't even aware. Of course, obviously you have crypto. I didn't even know there was different things that you could do and help to make that more liquid and usable as maybe the reserve portion. So that's really awesome, though. Yeah. Good extra little tidbit. And we love that DSCR loan. That's really a great, great product overall. And thank you for that awesome explanation. So with that one, that DSCR, of course, there's some other options too. Let's say let's say somebody was willing to be an owner occupied. Let's say you have someone who's willing to move out of their home, or maybe this is their first real estate purchase. There's some good options, I'm sure, for that type of loan, right?
Oh, absolutely. So if you're a first-time buyer, and I actually love talking to these first-time buyers that, I always break it down for them. Well, here's what it looks like with a single family, and here's what it looked like if we went into a two family. I always start with two, and then we talk about 3 and 4 later. And I always get the question, well, not always, because I work with some really good real estate agents that drop that bug already. But I just let them know, listen, you're just starting out. The property is going to be a little bit more money, but your mortgage is going to be mainly offset by the rents that you charge. So you're going to live there for basically I wouldn't say apartment rent anymore, right? Not with rent prices right now. But if you're comfortable with, say, paying, $1,500 out of your own pocket, you can get into a two family, even if that payment's a little bit higher than you wanted it to be. If you're charging anywhere from $1,800 to $2,500, that's money coming in that you could offset your mortgage with. So now you get into a home for 3.5% down. If we go with an FHA product, simply means it's a government loan. It's the most popular loan for whether you're a first-time buyer or not. You can use an FHA multiple times, just can't have two at the same time. Okay, really easy stuff there. And then you want to branch out after. you just simply have someone rent your unit. It's called departing primary. You're going to leave your primary residence now and go buy another home. So if you used FHA on your first home, a multifamily, 3.5% down, you now rent it out. So you've got some cash flow, passive income. So every month you're not going to work. People are paying you rent, right? You get some good tenants in there. You go through the credit check and everything. They're paying you on time. You can now get into a conventional loan on a single family purchase for only 5% down. So not a bad thing. So now you talk about getting into a $500,000 second home with only $25,000. Sorry, not a second home. It's your second home. I got to be careful. I don't say a second home. Sorry about that. So you can now start building your real estate empire with never putting down 20 or 25%. So I love having those conversations. I find that if someone is very open-minded, I'll give you a very quick example because I thought this would come up. I had a young lady that I helped qualify 3 years ago. She purchased a 4-family. Her mom co-signed for her at first, and then a little while later, as she, the equity the value went up, so she got some more equity, and she got a new job, so we were able to refi her mom off. So now this young lady owned and occupied a 4-family residence. So about a year ago, she called me and said, "Rob, I'm ready to move out on my own." I was like, "All right, let's do it. Let's see what we've got." Ran her credit. I took a look at what she had in the bank. She was very, very smart. I set her up with a financial advisor. So anytime I close someone, I try to be the center of the sphere, if you will. And I set her up with a financial advisor. It happened to be the one that I use. And he gave her a lot of really good advice. And he gave her a roadmap to retire early based upon the fact that she wanted to build more real estate pieces. And I use the word empire all the time, in her empire. So this young lady now owns a 4-family. The rents are 1.5 times her mortgage payment. Okay. So even if someone didn't occupy one of those, she's good. And we got her into a really nice single family residence where she's now married and expecting her first child. Aww. So those are the kind of stories that you love to hear. So even in this economy where eggs are $15 a carton, if played correctly and, under the guidance of ladies like yourselves, and, working with a really, not for nothing good mortgage broker, you can start to make some really good decisions. And when she's ready to retire, that 4-family is going to be her 401k, because what's that 4-family going to be worth in 3, 4, 5 years, especially now with the T working its way down to the South Coast, which is where I live, by the way. So she's got herself a really nice nest egg. So I hope that answers your question. It's a really long answer, but getting into your first home, if you want to go multifamily, give me a call. 3.5% down gets you there. Give yourself a little bit of patience, get the nest egg filled back up. Then we talk about vacating that or departing that so you can get into a single family residence. And the next question is going to be, can you go from a 4-unit to a 2-unit? That way you can leave the 2-unit and then go buy a 1-unit. And now your empire's, 25% larger, right? Or 75% larger. I guess it depends on how you're looking at that. And the way that works, because I get this question all the time. If you already own a single family home, let's be real. There isn't an underwriter out there that's going to believe you're going to leave a single family home in the suburbs to go live in a 3-family home in the city, and you're going to rent out your single family home. That's probably not going to fly. Okay. It's got to look realistic. However, a tangible benefit, that would be, what is the upgrade? How are you improving your life? Well, I'm not living with 3 other families anymore. I'm now moving to a 2-family with a, better school system, fenced in yard, 2-car garage. There's actually grass in the back versus just concrete everywhere. Crime's less. Whatever. Just pick a reason. You've got a tangible benefit there. And then, of course, when you depart that and go to a single family, well, the tangible benefit is, hey, I'm going to live by myself, and I don't want neighbors either upstairs, downstairs, or left or right. So, because I could see the wheels turning in Crystal's head, she was going to ask me that next, and and hopefully I stole your thunder a little bit there, but very, very possible, very possible. Now, when you do go from that single family, when you leave that 3-family and go to another 2-family, we're probably looking at 10% down, 5% down. It gets a little trickier, so you need a little bit more money. and the reason why I say it's a little bit more is because the value is going to be higher than a single family more often than not. So we gotta navigate it carefully. So we gotta draw up a good game plan and navigate that carefully, but very, very possible.
Yeah, that's awesome. I mean, you were right around the tracks of exactly what I was thinking. I will definitely say, like, my mind was also going to, we have the 4-family. Now we're in that single family home, but you know what? Like you said, that's the empire has started, but that's just the beginning. Well, now, like you said, houses are always improving. That equity is always building. It's not getting less expensive for a home. So now, for in your example, she has that 4-unit, probably has a ton of equity. So what about refi processes? What about that? What else can somebody in that situation do to prepare themselves to maybe refinance, take some of that equity out, and make their next investment purchase? It's probably as simple as a refi, I'm assuming, and then maybe go right to a DSCR loan again. Is that typically and the other thing, and I know this is kind of a big question, but what about reno loans? What about construction? What if somebody wants to, if they're, hubby that she's now married with a little one, well, he's super handy and he wants to get a 3-family fixer upper. What's the process for that? Can they bundle some construction loans and all that type of stuff in there?
All right, so we'll go one at a time. Let's talk about using other people's money. Okay, so you've got that 4-family home, and anyone will tell you always protect your own money. Okay, so once you're protecting your own money, now I want to go to the bank and I want to do a cash out refi. Right now, cash out refis are happening. It's still a viable option to use your house. I always like the joke of let's use your house as an ATM machine. Your house is loaded with cash. We just gotta, we gotta put our pin in there and take some cash out. If someone's sitting on a 2.5% interest rate from 2021, 2020, they may or may not want to do that. I still give them the option. If they don't want to do it, I now have 2 other options. Number one, we could do a second mortgage on a primary residence. So you're still living there. We have a fixed closed end second mortgage where they can now just take the cash out of that second mortgage and go and invest that cash somewhere else. And, at this point, we're obviously talking about another property. Okay. We also can do the cash out refi. And I have a few different HELOC products, home equity line of credit. Okay. And you can do that on an investment property. So you can have an investment property and take a HELOC. Not a lot of lenders will do that.
Right.
And, you're not going to get your 6 or 7% federal credit union loan. But remember, not your house. You don't live there. So the bank's going to mitigate their risk somehow. Any lender's going to mitigate that risk. But let's go with your first example. You still live in that 4-family. So you don't want to touch your 2.5% interest rate. So I'll show you an example of what a cash out refi will be at today's prevailing rate. And then I'll show you what a home equity line of credit looks like added to your mortgage. So if your regular mortgage is X, the HELOC is Y. Here's your payment, Crystal. What do you want to do? Do you want option A or do you want option B? Because there are 2 options. So you take that HELOC money. Now it's just sitting there. It's a line of credit. Take that check and put it down on your next home. So again, we want to make sure you can cover all that. In fact, when I run all of your ratios, so there are safeguards in place so nobody gets gouged here, we will run that payment and we'll show you what that HELOC looks like. HELOCs are typically interest only. However, we qualify you on interest and principal just so you don't get yourself in trouble. So it's not 2005 anymore, right? No more, that stuff doesn't exist anymore. So now we're looking at, these are your options. Are you comfortable with that? If the option, if they, you can hear a lot of times the phone goes silent, something's up. We probably gotta, of course I don't say anything. I just let them stew on it for a couple of minutes. But if they say, yes, let's go, that's fine. We were actually thinking higher. I love hearing that. Now I can sleep at night knowing that you're comfortable and you can be able to make all those payments. So let's roll on to the next. So cash out refi, second mortgage fixed, or a home equity line of credit. So those are our 3 options. And then we can take that stuff. And yes, the easiest way is that DSCR loan. We can do your classic investment, Fannie Mae, Freddie Mac, the 2 governing bodies of mortgages, okay? We can go by their guidelines and go 25, 30% down on an investment property. We have to enter all of your debt into the equation. It's not that it's difficult. the reason why I said all of your debt is because it takes a little bit longer, right? There's a lot more paperwork involved. And honestly, these days with these DSCR products, it's not like you're getting much better of an interest rate, if at all. Because keep in mind, being a mortgage broker, I have multiple lenders. We have 29 or 31 lenders at our disposal. So one's always going to want to beat the next, and so on and so forth. So it's a very competitive space now.
Nice.
Oh, and then you talked about rehab. Sorry.
Oh, no problem. I threw so much at you.
Yeah.
My mind was going so
Right.
quickly. It's just, it's just a
That's
really
okay.
good progression. It's something that happens a lot. Once you've made your first investment, you're ready to make that next investment. And then every time, you have a little bit higher tolerance for risk. And when you're higher tolerance for risk, you definitely need to have more knowledge and more information on some of the back end things even. And maybe we haven't chatted about that stuff enough yet. Like, what do you need to prepare yourself? Like, if I'm coming to the table to chat with you, what should I already have ready? Should I have, like, what information are you going to need from that person that you're giving a loan to?
Okay. So are we talking an investor or a first-time buyer, that is going to become an investor?
Maybe a second time buyer that's making their first investment. They only own a home.
So, okay. So things that I'm going to look at, obviously we're going to have a conversation about where you're comfortable. I always ask people, and I take a quick note, give me a payment that you're going to be comfortable with. And, obviously I'm kind of ad-libbing a bit here. The conversation's a little bit more, considerably more personal.
Yes.
And I jot that payment down. From there, I'd say be prepared with, because in case we don't go the DSCR route for any reason, okay, let's just talk about regular, everyday, Fannie Mae, Freddie Mac conventional loans. You got to come ready with your bank statements, of course. And if you only have crypto, again, we can talk about that. There are ways to get that seasoned so we can use all of those funds. We're going to talk about your job. So let's talk about W-2s and or 1099s and tax returns. And then let's talk about, your mortgage payment or your mortgage statement and what's going on with your mortgage. I like to analyze people's mortgage because if they're not in an FHA, well, now my mind's already thinking, all right, well, if you're going to step out of that house, we can get you into an FHA later. Those are all things, and we don't have to go down that rabbit hole right now, but those are all things that I like to see. So when people come prepared, and I, obviously I let people know, hey, listen, we're going to meet in person or on Zoom, like kind of like we are right now or whatever. Have these things available. I'd like to see your W-2s, a current pay stub, your mortgage statement, and then let's talk about what you've got in the bank. And then from there, we just kind of we kind of take off from there. If they're looking to get into another owner occupied situation, like I mentioned before, the person going from a 4 to a 1 or a 4 to a 2, then there's no DSCR. Now we're talking, we got to line everything up. And let's say it's someone that has multiple properties and now they want to get a third. I've got to make sure that they are crystal clear with me as to which mortgage statement is attached to which property, because how much money you're bringing in rent to offset your mortgage payment is super important for me to draw that, paint that big picture for you. And then lastly, I say, come with an open mind. Okay. Everyone's got that uncle, brothers, cousin, something at work. Oh man, my buddy bought an investment property for 3% down.
True.
No, he did not.
Yeah.
Not unless he committed mortgage fraud. He did not do that. So I always ask people for a little bit of an open mind. I make a joke kind of like I just did now. I try to keep everything lighthearted. So, I say come prepared to learn, because I'm definitely going to teach you some things. Bring all of those documents. And then also, I'm not a financial planner, but talk to me about your plan, right? So if I'm talking to someone, and let's say I'm talking to a young couple, and just through course of conversation, I discover that they want to have a baby. And when they have this baby, and they're actively trying, when they have this baby, mom's not going to go back to work. Okay, so now I can qualify you with all of mom's paperwork, of course. I may know that there's no continuance there. I don't have to disclose that because you're not telling me that you're leaving the country or anything like that. So, and you may not even ever get pregnant. You may decide that you want to stay working. But if I get you to 50%, which is the maximum I can get you of your debt to income ratio, and I know you're not going back to work, that's going to be a longer conversation. Hey, listen, what's this going to look like if you can't rent this place? I want to sleep at night knowing that you're not going to go belly up bankrupt. Okay. So again, that's where coming prepared to talk. The worst thing, on full disclosure, is when I get someone wanting to get into an investment property and it's bing, bang, boom. They don't want to take the time for a conversation and it's a very choppy process. So I guess, Crystal, the biggest thing that I ask for is time and patience because this is a process. Again, like you said, we're taking on more risk. And I consider it my job to let you know what that risk is and to prepare you for it. How's that for a short answer?
Well, I have a couple of things come to mind that you mentioned. So for our listeners, like maybe they don't know what that means that you're a mortgage broker. Could you expand a little bit on that topic?
Yeah, I'm happy to. Thank you. So being a mortgage broker, I don't work 9 to 5. I don't work at a bank. So if you walk into Bank X and whatever the manager greets you because you're waiting in line to talk to someone because you don't know what to do, and you say, "Hey, I'm here for a mortgage." You go sit down in the comfy leather chair. They bring you water, and someone comes out, and you sit with them, and they probably have all of the knowledge in the world, but they only have their products. Some banks do not offer government loans. So Crystal mentioned earlier, I love helping veterans. They don't offer VA loans. That's a no money down loan. They don't offer 3.5% FHA. There's just not that option. They can only offer you what they have available. Okay, so when you come to a mortgage broker, number one, I may not be the internet, but I work Monday through Sunday and back to Monday again. I'm issuing pre-approvals when I'm on vacation, like I talked about before we jumped on here, right? So a mortgage broker is going, at least a good one, is going to be more readily available. And the other thing is how I mentioned before, I have different options and I have 31 lenders. So being a wholesale broker, I can go to places that you cannot walk into. They're a giant warehouse full of money and they want to give you money to go buy a house. We all follow the same exact guidelines. We just have more products readily available, unlike Bank X that only, and don't get me wrong, banks do some pretty cool things because we are actually affiliated with 2 different banks. One is a really strong relationship. I can offer those bank products that are specialty products. CRA stands for Community Reinvestment Act. And what that means is if I want to write a loan in the city of New Bedford, Taunton, Fall River, those are gateway cities, they're very populated cities. This particular bank has products specifically for those cities. So they're reinvesting back into the community. I have access to those products, just like the mortgage person that works at that bank does. And I have all of these other options. Okay, the biggest thing that this means, though, because that was a lot of words, right? The biggest thing that this means is if you walk into Bank X on Tuesday with a sales contract, you're getting their rate, their product that day. You come to a mortgage broker like myself, I pull up, there are probably 4 or 5 of the really big lenders in the country that we have access to. I have a pricing engine and I run your transaction, your deal, if you will, through my pricing engine. And all 4 or 5 of those, plus that bank, pop up, and I will see the best rate on that given day. And it's probably going to be better, or at the very least competitive, with that one bank. And then I also have I have other options too. Like if you tell me, Tamara, that you want to live in this home for 2 years and then sell it so as not to pay capital gains, et cetera. By the way, consultant accountant, I'm not an accountant, but then I can get you in an adjustable rate mortgage with a really killer interest rate. It's an awesome product. You're not taking on any risk because you're going to sell in 2 years. The bank that you walk into off the street that holds your checking and savings account and CD may not have that stuff.
Right.
So that's a difference coming to a broker. I just have a lot more options.
Nice.
And I'm way more readily available.
Yeah, bank hours are tricky. That's for sure. Very tricky. But that was awesome.
Readily available. And also what about your, like, when you first talk to you to when you close? Like, what are your, like, turn times?
Oh, I love that question because yep, I know exactly what you're talking about. So if you handed me a contract today, my average close time are, they call it commitment, CTC, clear to close. That's when I announce to the world, hey, Tamara can buy this house. I know we're not closing for another X amount of days, but we're good. My feet are up on my desk. Send me another client. I'm ready to go. My personal average is 13 days. So you give me a contract within 13 days, I've got you ready to go.
Awesome.
So really, that's like almost the same, if not the same, as having cash.
It's
like closing with
you
cash.
know,
Like that's for being
Yep.
in the real estate industry for a good amount of time. I've been needing, really requiring to have that conversation because they've wanted, buyers have wanted like this discount if they're coming to the table with cash. And even if it's 2 days, even if it's 7 days, well, they're not going to give you the same. They're not going to really not going to give you any discount because it's really the same. Do you know?
Yeah.
So that's
Working.
something about lending that has really, improved overall, is the process of like beginning to end and those turn times.
Yep, absolutely. So we at Milestone Mortgage, we do a really good job of getting everyone prepared up front. So we
Mhm.
actually have some lenders that if I qualify to buyer, I'm not an underwriter, okay?
Right.
But I can look at a file, I can determine your income, I can look at your debt to income ratio, et cetera, all the fancy terminology that goes along there. I have multiple lenders where I can send, while you're out there shopping with your real estate agent, I can send your file. It's called TBD, to be determined.
Mhm.
Instead of putting in an address, I just type the letters TBD, and my lenders will fully underwrite the file. So when you go under contract, all we need is appraisal, title, and insurance. And I usually have the insurance ready to go because I have some really great relationships, very, very, very strong relationships. And then we can close even faster because appraisers now, there's not a lot of inventory out there. You're not fighting to get an appraisal done in 30, 45 days. We have appraisers that go out 2-3 days later. And if they get us that report quickly enough, because they get paid when they get us the report, we can close sometimes it's not unheard of to close inside of 7 days.
That's awesome.
And yes, and that gets us very, very competitive with cash. Very, very competitive with cash.
Exactly.
And like you said, it's the big thing about real estate. It's how can you use other people's money? It's about
Exactly.
leverage. It's about less out of your pocket, do more for less. That's a really big priority. So I don't think cash is king anymore. Being liquid is king, and having the right knowledge and information to get what you need done in the right way as quick as possible is just the way to go. And I loved your explanation and that was a great question, Tamara, regarding, what exactly is a mortgage broker? Because I know when I bought my first 3-family, I thought to myself, well, why wouldn't I just go to a bank? Why would I pay somebody to help me? It didn't make sense to me. Like maybe I could get a better rate. And, it didn't add up to me until I did my research and I did my digging. And I'm like, oh, I'm going to have somebody at bat for me. I'm going to have somebody working for me to get me the best rate. Like you said, you have all those people being competitive that wants to get that sale, wants to be the one that gets that loan. So it's a really, really helpful bit of information.
Yep, absolutely, absolutely. And we get paid. The other thing too is I don't operate on a salary.
Mhm.
And I'm very upfront with my clients. I let them know, hey, I get paid by the lender. You will never stroke a check to myself or to Milestone Mortgage Solutions. I get paid after the closing table, and it's based upon volume and units between my company and the lender. So you never have to worry about that. What that means for you, why that is a benefit, is I'm always on the clock. I don't collect if I don't close. And if I don't have any closings, I don't have a paycheck. I have to look at my wife and say, hope you can pay the mortgage this month, sweetie, because I can't, So it entices me to, yes, if I don't know, if I'm sitting on the beach and we're just relaxing and the phone chirps and someone needs a pre-approval letter, it entices me to not say, I'll get that to you later. No, I grab my phone. And again, with all of our technology is second to none right now in the country. We can take care of everything right on our phones, phone, tablet, whatever. And I think to me, that's a big difference. I remember buying my first house, and my buddy at the time was a mortgage broker. And I remember calling him on a Sunday, and he answered the phone. I was like, oh, dude, I was expecting to leave you a voicemail. And he's like, no, if you need me, I'm here. I don't get paid unless I call you, unless I answer the phone when you call. And, a lot of my friends, close friends now, that I've developed through this particular line of work, whenever they have someone and they're working with a bank and they need something on a Saturday, Sunday, and we've all seen the open houses where the lines are around the door and you want to get that offer in quickly. Some bankers will answer the phone. I'm not going to say they won't. I'm not going to say all won't. But for the majority, you're waiting till Monday. And if Monday's a holiday, you're waiting till Tuesday. And, your butt's now out the door with that offer because someone else came along.
Yep. So true. So very true. And I will say I feel like the one last thing we should probably touch on before we um stop chatting, because I think we could just go on forever. But I'm one thing you hear right now is that it's too hard of a time to buy because the interest rates are too high. And what do you think about that? Because
I
we're
love this
all
one.
kind of yeah. What's your thoughts on that? Let's hear it.
So if I can be a little, I'll try to add a little bit of humor to this because it is stressful, right? It's
Yeah.
stressful. You're not making a purchase, you're making an investment. And people, number one, have to realize that. So it's our job in this industry to educate people on you're not buying something. This isn't a pair of Nike sneakers that you're going to wear out. This is at home. This is an investment. So where you're going to raise your kids and or retire. One or the other. It's one or the other, right? Usually. Or at least that's your thought process, right? To anyone that tells me that as an objection, and I say that's fine. I mean, an objection is nothing more than what do they say? An excuse in the absence of value, right? So I would say this. I have a client that we recently closed, and they've been with me for 3 years. Interest rates started ticking up in 2022. Rob, I'm going to wait. I'm going to wait. I'm going to wait. My dad told me that after the new year, rates are going to come down. I don't know. Does your dad work for the Fed? I don't understand why. But okay, sure, no problem. I'm not pushy. I'm a very relaxed guy. I'm the best guy that you could work with. No problem. So now 2023, rates keep going up. Keep hearing the same thing. I keep checking in. Rates keep going up. Dad keeps saying to wait. 2024, slight dip in September, right? There was a 2-week gap in September last year where rates came down a little bit. Everyone got excited. Refis, purchases, people out there. It felt like 2021 all over again. And then rates went up just a little bit. And by the way, when I say they came down, they barely moved, but people got excited because they saw the number 5, right? And that makes sense. Same client, didn't buy a house. Waited. So we just closed the other day. She closed on a house that was less than 1,000 square feet, paid $. Now, you're all very powerful women in this industry. You know what's going on. Colleen just raised her eyebrows. How much was that home worth in 2022? It wasn't 400,000 plus, right?
I can guess. I don't even know where it is, but I could guess that it was about probably 325 to 350.
Yeah.
It was right in that range. It was in the low 300s.
Yep.
And now we had a fun little exercise, and then she made me tell her what the math was. So I was like, okay, you're gonna go back and tell Dad, because she knew I'm not gonna say overpaid, because she paid what the market is now. That's not overpaying. No. Yeah. It's what the market dictates. So it's what the market dictates. Right. So if she would have bought the home at the prevailing interest rate in, say, 2023 at that $322,000 mark, or 2022 rather, at 4.5%, almost 5%, versus buying now at the low 6s, because we put her in an adjustable rate mortgage, but she paid $100,000 more. She was paying over $100 more per month. Same house. So I simply tell people, we can wait all you want. I'm a very patient person. Just keep sending me docs. I'm going to check in. I'm not going to be a pain in the butt. I have an automated system that's going to send you happy birthday emails and all this fun stuff. Just remember, home values are not going down. So if the interest rate falls 0.5%, all that seller is going to do is look at the line of people out the door and say, I'm getting 50 grand more for this. Why wouldn't you? Because now you have no supply and a ton more demand. So that is the way a lot of people have been buying more or getting out more often, is we're just explaining to them. And listen, I didn't invent that. I'm not the only mortgage person out there saying that. Real estate agents are telling people the same thing. It's like, we can wait, but your price range is always going to be your price range. In fact, you're going to be, if you want your payment to be here and you want to wait a year, I don't care what the interest rate does, that home value is going to go higher, which means now you're buying less home because you want your payment to be X. So, we show the value. A $400,000 home, here's your payment. It's where you want it to be. Oh, well, the interest rate's high, but it's a nice home and it's where you want your payment to be. Or we wait. That same house next year is $500,000 and your payment's going to be higher. So that's the advice that I give people. I always do it lighthearted. I try to get them laughing, kind of like I got you laughing here, because it is, again, it's stressful. It's stressful. No one knows what's going to happen tomorrow. And, my favorite one was everyone wanted to wait for the election. You know,
Oh
and
my
I laugh with all my clients. I'm not making fun of anyone, and they all
God.
know. They all know. The ones that waited, they all know they gambled and they didn't win.
And, in the end, I think the three of us well, obviously we discussed this before, and we kind of are of the mindset that you're married to the home, not the interest rate. You can refi
Correct.
when it's the right time to do so. But like you said, if you want to get the most value out of your payment, and that's when the prices are going to be lowered. Worry less about the interest rate. Refi if that magic moment comes up in a year or two. So it's just,
Yep.
man, so
The
much.
equity built will always outweigh how much extra your interest rate was.
Yes. Yep. So true.
Well, we really appreciate you being here, Rob. And I think it's been very informative and very important to bring this type of thing to the forefront to our listeners because, you need that money. Like, you can't just talk about the investment and then not have the money needs to follow. I mean, it's somewhere in the mix of things for certain. So this has been very educational and informative, and it's great to talk about that product because the DSCR loan has not been around that long and available to anyone that wants to invest in real estate, and we all love real estate. And so we appreciate your time and discussing this. So we just want to say thanks to our listeners for meeting us here at the round table. And if you want to learn more, you can check us out on Instagram, Facebook, or YouTube, and visit our website at therealestatewomen.com.
Thank you. And Rob, if our
Fantastic.
listeners wanted to reach out to you, where could they do that?
I'm glad you asked. Thank you. So I can be reached. My phone number is area code 508-264-1536. If you want to find me on social media, it's on Instagram. It's just R Serpa, nice and easy. And on Facebook, it's Rob Serpa. So ROB space SERPA, pretty easy. Or call Crystal. She's got my number.
Yes, I do.
And thank you very much for being here. This was a lot of fun. It's a pleasure to meet everyone. I had a lot of fun doing this. I'd be happy to come back anytime. I love what you ladies are doing out there, educating everyone. So I jumped at the chance when Crystal asked. So very happy to be here. Very grateful.
Yes. Thank you so much. It's been great. Take care, everybody.
All right. Bye-bye.
The information contained in this podcast is for educational purposes only. We are not licensed professionals and do not give investment advice, tax advice, or other professional advice. Please consult a licensed professional before making any financial decisions.